Welcome back, students and scholars. In this third ASC 220 lesson, we are moving into special reporting issues. This is the judgment part of the topic, where the numbers may be correct, but the presentation can still create confusion if the item is placed, labeled, or explained poorly. Today, we will cover non-GAAP caution, unusual or infrequently occurring items, and business interruption insurance proceeds. Think of this video as the presentation quality control session. The accounting may be technically correct, but if the presentation misleads users, the financial statements still have a problem. Our learning path has 4 checkpoints. First, we will see how alternative performance measures can become misleading if they are not reconciled and labeled properly. Second, we will separate unusual nature from infrequency of occurrence. Third, we will understand how business interruption insurance proceeds are presented based on the nature of the loss. Fourth, we will build exam decision hooks so you can apply these rules under pressure. Keep this sequence in mind: non-GAAP discipline, nature test, recurrence test, and presentation judgment. Before we go into the details, organize the video into 3 buckets. Bucket 1 is performance measures, especially alternative or non-GAAP measures presented outside the core GAAP financial statements. Bucket 2 is continuing operations, where unusual or infrequently occurring items are presented separately but still remain inside continuing operations. Bucket 3 is insurance recoveries, where business interruption proceeds follow the nature of the covered loss. These 3 buckets will keep the topic clean, because without buckets, special reporting issues can quickly become a drawer full of accounting cables. Let us start with pro forma and non-GAAP measures. Companies often use labels like adjusted EBI, TDA, core earnings, cash earnings, or adjusted net income to communicate what management believes is underlying performance. The risk is that these labels do not have one universal definition. One company's adjusted earnings may exclude stock compensation, while another may include it. One company may remove restructuring costs every year and still call them one-time. So the exam-ready phrase is this: non-GAAP measures need discipline. They are not automatically wrong, but they must not mislead users. The main control around non-GAAP measures is reconciliation to a comparable GAAP measure. A reconciliation shows the GAAP starting point, each adjustment, and the final non-GAAP figure. This keeps the alternative performance measure anchored to the reporting framework. Without that anchor, the number can become more of a storytelling tool than a reporting tool. A strong reconciliation answers 3 questions. What GAAP number did we start with? What adjustments were made? And why were those adjustments made? There are also presentation zones where non-GAAP measures can create serious problems. They should not appear on the face of GAAP financial statements as if they are GAAP line items. They should not be used in the notes as substitutes for GAAP performance. They also should not use titles that sound confusingly similar to GAAP measures. The test is simple. Could a reasonable user mistake this number for a GAAP result? If yes, the presentation needs correction. A label is small, but sometimes it carries a very large reporting headache. One of the biggest traps is the word non-recurring. A company may exclude a charge and call it one time, but the facts may tell a different story. If similar charges occurred in recent prior periods, or the item is reasonably likely to recur in the near future, the non-recurring label becomes weak. Think of restructuring costs that appear every year, legal costs in an industry with constant litigation, or acquisition costs for a company that keeps buying businesses. If the same cost is called one time every year, students and auditors should both raise an eyebrow. Now let us move to unusual items. Under ASC 220, unusual nature is a judgment test. The item must have a high degree of abnormality and must be clearly unrelated or only incidentally related to the ordinary activities of the entity. Notice what this does not say. It does not say large amount equals unusual. A large item can still be ordinary if it arises from normal operations. The real question is, what kind of item is this, and does it stand outside the entity's normal business pattern? Entity context matters heavily. The same event can be unusual for one company and ordinary for another. A major equipment breakdown may be unusual for a software consulting firm, but not necessarily unusual for a heavy manufacturing company where equipment downtime is part of operating risk. A flood loss may be unusual in a historically dry region, but less unusual for a company operating in a known flood zone. Industry, geography, operations, and regulation all shape the judgment. In accounting, context is not background decoration, it is often the answer. Infrequency of occurrence is a separate test. Here the question is not what kind of item is it, the question is how often is it expected to happen. An item is infrequent if it is not reasonably expected to recur in the foreseeable future based on the entity's environment and facts. Past history, current business plans, market conditions, and industry conditions all matter. An item may be unusual without being infrequent or infrequent without being unusual. That is why the two tests must be evaluated separately. Now comes the presentation rule and the EPS trap. Unusual or infrequently occurring items are presented as a separate component within income from continuing operations. They are not removed from the income statement. They are not pushed below continuing operations as a separate category. Under current US GAAP, the old extraordinary item category no longer exists. Also remember the EPS trap. No separate EPS line is presented for the unusual or infrequent item on the face of the income statement. There is no secret basement below continuing operations for these items to hide in. Here is a simple memory test. Unusual asks, what kind? This is the nature test. Infrequent asks, how often? This is the recurrence test. Presentation asks, where? The answer is inside continuing operations as a separate component with no separate per share line on the face. These three questions are powerful in exams because they stop you from mixing classification, recurrence, and presentation. When a fact pattern looks messy, slow down and answer kind, often, and where. Now let us discuss business interruption insurance. This coverage responds when operations are suspended or reduced because of a covered event such as physical damage to property. The policy may compensate the entity for lost gross margin, continuing fixed charges, or extra costs incurred to reduce the interruption. The key point is that business interruption insurance is not one generic recovery bucket. Different parts of the proceeds may relate to different underlying losses, and those parts may need different presentation. The controlling principle is classification by the nature of the loss. If proceeds compensate lost gross margin, the presentation should reflect that nature. If they reimburse continuing fixed charges, they should align with those costs. If they reimburse extra expenses, they should offset or relate to those extra expense lines. Also remember the asset rebuild rule. If insurance proceeds relate to replacing or rebuilding a damaged asset, do not reduce the capitalized cost of the new asset. Insurance proceeds do not get to sneak into the asset account and quietly lower the cost. Present the asset and the recovery gross. Disclosure is where presentation quality becomes visible. The financial statement should help users understand what happened, what was recovered, where the recovery appears, and whether any uncertainty remains. A good disclosure identifies the covered event, describes the components of the proceeds, explains the income statement lines affected, and separates insurance recoveries from asset replacement costs when both exist. This is not just a checklist. The real test is whether a reasonable user can follow the story without guessing. Let us close with 4 exam and practice anchors. Non-GAAP measures need reconciliation, clear labeling, and disciplined placement. Unusual is a nature test. What kind of item is it? Infrequent is a recurrence test. How often is it expected to happen? Insurance follows the loss. Loss margin, fixed charges, extra costs, or asset replacement. In the next video, we will apply ASC 220 through a practical illustration from net income to comprehensive income. Please like the video, share it with your colleagues, subscribe to Commerce Regiment and support the channel so we can keep building serious accounting education together.